Presentation 3 in the Management of Finance is about final accounts. In here, we're going to look at income statements and statements of financial position. So the learning intention is then to be able to understand the purpose of income statements and statements of financial position and where they fit in here, to become familiar with the terminology used in these statements, to be aware of the layout of these two financial statements, and to understand how the figures are calculated and what these mean for an organisation. Financial statements then consist of an income statement and a statement of financial position. The first one we're going to look at is the income statement, and it's broken down into two parts really. We've got the trading section and we've got the profit and loss section. So let's look at the trading section first. The trading section shows the profit or loss made from buying and selling goods and services. It compares the value of sales to the customer with the value of sales at cost price. So, for example, if you're selling a Mars bar for 50 pence, you might be able to buy those Mars bars in for 40 pence, which means that you have made a gross profit of 10 pence per Mars bar. That's quite simplistic, but it kind of works on that premise. The main activity of any organisation involved in trading is the purchase of the goods and selling them on to the customer at a higher price. That's what private sector organisations are all about. They're all about making profit, which means that you have to buy products in or produce them, manufacture them at a cheaper price, which allows you to sell them then at a higher price. And the difference between the sales value, we sometimes call it turnover, and the cost of the sales is what we call the gross profit. In the income statement trading section, we have a number of different factors go into this, a number of different figures will go in here, and it's really important to understand what these are. The sales revenue is the number of products you've sold multiplied by their price, and we sometimes call that turnover. Purchases are the goods that you buy from the supplier, so they will hopefully be bought at a lower price. Returns inwards are sometimes called sales returns, and these are goods that are returned by customers to you. They are returned back into the business, perhaps because the order was wrong or the order's faulty. So we call these returns in, and these are deducted from your sales revenue figure, because what they're actually doing is reducing the value of sales that you have actually sold. Returns out are the opposite, and these are purchase returns, and these are goods that we as a business, we have purchased goods, we find they're wrong or they're faulty, then we are sending them back out to the supplier. And what would happen there is they're going to decrease our purchases figure, so the purchases figure is going to be deducted with the value of any returns that you send back to your supplier, purchases returns. Carriage inwards is the cost of delivering this inventory, this stock, these goods to your shop or your warehouse. Really just a delivery charge that you're having to foot the bill for. Inventory at the start of the trading period is called your opening inventory, and that's the amount of inventory or stock of a product you have already at the start of the year. We don't start a fresh year with absolutely no stock or no inventory. We will have some carried over from last year. You'll still have cans of beans on your shelf or Mars bars on your shelves, which means that we call that opening inventory. Closing inventory is the inventory at the end of the financial year that we still haven't managed to sell, which makes that next year's opening inventory. So this year's opening was last year's closing. The profit and loss section, the income statement finds this thing called a gross profit, which is the difference between the sales revenue and the cost of sales. We then have to say, well, that's not the final profit that a business earns. We are looking for this figure called the profit for the year. And what we have to do to the gross profit figure is we actually have to deduct any expenses that the business has actually incurred over that period. The section calculates the final profit or loss, we call it the profit or loss for the year, that an organisation has made over a financial time period. It starts with a gross profit figure from the trading account section and lists any items of additional revenue raised by the organisation, as well as expenses incurred, not directly linked to trading. So it could be, for example, that you have perhaps received a discount from another company. You maybe have part of your premises you rent out, so you're receiving rent. The way to kind of distinguish an income that gets added back to your gross profit is it's normally got the word received at the end of it. Rent received, discount received, commission received, all these sorts of things. Expenses will be things like rent and rates, salaries, electricity, heating, all those sorts of things, and they would be deducted from your gross profit. So this is a wee list of items that could be in the income part or the expenses part of your profit and loss section of your income statement. So we've got here things like discounts received, commission received as additional income that you would add back. We've got here in the profit on the disposal of assets. Sometimes businesses will sell a machine or a piece of equipment that they no longer use, and they might be able to sell that piece of equipment at a higher price than it's actually worth. And what we call that is, we call that a profit on sale or disposal, which is the word we use. On the other side here, you'll see that there are expenses here that you would perhaps, some expenses that you would perhaps deduct from your profit and loss section, your gross profit here in the profit and loss section. And it should look like this. The layout of the income statement should look like this. In another presentation, I will do a little demo of all the different parts of this so that you can see where they're all coming from. So that will be in an additional PowerPoint. And the second section here shows you the profit and loss section of the income statement, taking us down to this figure called the profit for the year. As I said, I will explain that shortly. The statement of financial position is the next part. These are part of what we would call the published accounts, which an organisation, a limited company, would have to write up every single year. All organisations should do this to let them see the profit they've made for that year and what the business is worth, which is what the statement of financial position is all about. So it really shows the assets of an organisation, the items it owns like machinery, equipment, premises, etc., and its liabilities. Liabilities are things you owe to other people. So it includes the value of the organisation's assets. We have non-current assets and current assets. Non-current assets are those assets that their value doesn't change very readily. They tend to be worth a lot of money, and you tend to hold on to them for a long period of time. For example, premises, vehicles, machinery. Your current assets are constantly changing. Their value is changing all the time. For example, your inventory, your trade receivables, which are the people that you owe you money, people that you have sold to, and they sold on credit, and they owe you the money for them. We talked about this in the last presentation. Your bank account balance, your cash, etc. The liabilities of the organisation are also included here. Your non-current liabilities are your long-term loans, etc., mortgages, things like that. Liabilities, amounts of money you owe that are going to last for a longer period of time, normally more than a year. Your current liabilities are those debts that are going to be paid back quickly. For example, your trade payables, people that you owe money to because you've purchased on credit. It could be bank overdrafts, etc. The statement of financial position will also include the equity of the company, and that's the share value. That's the amount of money that the business has actually raised. Okay, we sometimes call it capital, and it's really how the business is financed. So here are just these terms again that I have just gone over with you. Your non-current assets, they generate income, they don't tend to change value, they tend to be worth a lot of money. You've got your current assets, that their value is changing all the time. You've got your current liabilities, that are debts that are repaid in a short time, and your non-current liabilities, which are debts that are paid over a longer period of time, normally more than a year. You also have here your a figure called working equity, and we're going to talk about that a little bit more when we look at our ratios in the next section. And the working equity is the amount of kind of ready-ish kind of cash flow you've got available in your business at a point in time. And the way we find that is we take our current liabilities, our short-term debt, away from our current assets. We really hope that our current assets should be higher than current liabilities. As I say, we'll look at this again in the ratio section to ensure that the business has got a positive cash flow. Equity, as we've just talked about, is the money invested in the organisation, normally through the sale of shares. Drawings tend to happen for sole traders and partnerships, and this is the amount of money that the sole trader or partners will withdraw from the organisation for their own personal use. Now, what drawings do is they reduce the value of the business. So any equity you have in the business, you have to deduct your drawings figure from that if there's any of it. Your profit from the year is going to be taken from your income statement, and the profit from the year increases the value of the company. So the statement of financial position, once again, I'm going to do an extra little demo and I'm going to talk through each of these in turn, and you'll see that this is what it looks like. The statement of financial positions in two parts. It used to be called a balance sheet. We have our non-current assets, our current assets, our non-current and current liabilities here. And what we have to do is we have to prove where did this money come from to be able to do this, and that is on this second section here, which shows us how the business has raised that money. And we can see here that they've raised it through issuing shares and the reserves from their profit and loss account, which is really their profit for the year figure. And that is how a statement of financial position is laid out. Thank you.